Yeah, so what I've been tracking over the past several months is this, especially this liquidity environment, and basically the whole thing was, it's like ironically because the debt ceiling, and they have to draw down their cash balance. It's actually been constructive for liquidity in recent months, and that was something that for months now I've been writing about, saying that ironically this is a type of environment where some of this bad stuff can actually be surprisingly decent for the market, and that's I think part of why the S&P 500 has been holding up pretty well, and so you have this environment where it does not look good. I mean, it looks good for a period of time until you get to that point where it actually hits the road, right? Mm-hmm. When you actually run out of the TGA, when you actually get to either the government shutdown or the impasse, and then the need to refill it. And so I think that explains a big chunk of why the equity market is ignoring the CDS, it's ignoring some of the other, kind of indicators we're having. The same thing actually happened going into the COVID crash. Basically, you had, commodities started to smell it out. You had basically a number of analysts point out that this, the virus is actually serious, it's actually going to spread. You had a lot of fundamental research kind of pointing in a direction, and the equity market, it just didn't price it in at all, week after week after week. It was not pricing in at all, and then it was all priced in at once. Yep. And so I maybe a less extreme version, more like the chart you showed, I think that's something to be wary of later this spring or early this summer. Exactly when it hits, we'll see. But essentially that, the ongoing liquidity is still decent at this time, but it points towards a liquidity train wreck going forward. Partially, you define your time frames, first of all. And so basically, some people, what they do is they put Bitcoin in a different segment where they say, this is something I'm not going to touch for a certain period of time. Kind of like how if you have physical gold in your house versus, say, a paper gold in your portfolio, you might treat them differently. You might say that the physical gold, I'm not going to worry about the price. I'm not going to worry about timing anything, whereas the paper gold, I might try to do that. Yep. I think this is the same for Bitcoin. I think there's, if you define yourself as a Bitcoin trader, you want to focus heavily on things like liquidity. I've done a lot of work on trying to figure out what are the main factors that are the strongest correlation with Bitcoin price. So, historically, one of the ones is the halving, but that's actually not really good for a specific timing purpose. Generally, liquidity and economic indicators are better. So, if you put it simply, if you buy Bitcoin when the PMI is rising, you're going to have a better time than if you buy Bitcoin when the PMI is falling. And if you want to get more precise than that, if you look at various liquidity indicators, they generally front-run PMI a little bit. Yep. And Bitcoin also tends to front-run PMI a little bit. So actually the closest correlate that I've generally found for Bitcoin is various measures of liquidity, both domestic liquidity and then global liquidity, including, say, dollar-denominated global M2 in rate of change terms. Those are the types of things that correlate heavily with Bitcoin. And so in any sort of like near-term environment, if you're trying to judge what it's going to do in a multi-week or multi-month period, you have to generally have a decent view on what liquidity is going to do. Whereas long-term, you can look at things like, what percentage of the supply is liquid versus like tightly held. What are the developments happening on that whole ecosystem? So what is making Bitcoin better to use, better to interact with? What are the other technologies kind of building on that whole stack? And so the way that I view Bitcoin is I have this kind of long-term holding, this very long-term structural view that I occasionally check to make sure that thesis is still in place. But then I use the shorter-term stuff, the cyclical stuff, to one, manage position sizes, and then two, set expectations in a near term. And so, for example, I would use, during this past cycle, I would use GBTC as a way to, get in or get out, kind of change my position in that sense. Whereas, like, say, cold storage Bitcoin, I treat more like physical gold, where it's something that you have a structural view on that you almost hold as a separate category. I think that's absolutely a factor. And like I said before, when I was doing research to figure out what is most correlated with Bitcoin, I kind of touched on multiple areas. Like one is that economic rate of change, like, PMI, or, a set of indicators that kind of resemble something like PMI. Is the economy accelerating or decelerating? That is a pretty strong, and the reason those both work is that both liquidity and the quads or the economic cycle are rather correlated in themselves, because liquidity is kind of a big component that helps drive economic cycles one way or another. And so you kind of get a slight difference on the exact timing. But yeah, essentially, I do think that this recent liquidity pump was a big factor. Now, obviously, Bitcoin has been rising before you got this big March liquidity injection.